Welcome to another video. Today we'll be looking at momentum trading strategies. Momentum trading is one of the simplest forms of trading styles where traders buy and sell assets based on price trends. Momentum trading strategies focus on price action and price movements instead of fundamental factors and long-term growth. Basically, momentum trading is a trading strategy in which traders buy financial assets when they're rising and sell them when they seem to have peaked. Momentum trading is based on these key factors: volume, volatility, and time frames. Volume is the amount of a particular asset that is trading within a given time frame. It is important to momentum traders as they need to be able to enter and exit positions quickly, which depends on there being a steady stream of buyers and sellers in the markets. Volatility is the degree of change in an asset's price. If a market is highly volatile, it means that there are big price swings, while a market with low volatility is comparable stable. Momentum traders will look for volatile markets to take advantage of short-term rises and falls in an asset's value. As momentum trading tries to capitalize on volatility, it is important to have a suitable risk management strategy in place to protect your trades from adverse market movements. This should include stops and limits. Momentum trading strategies usually focus on short-term market movements, but the duration of a trade can depend on how long the trend maintains its strength. This could make it suitable for traders who use long-term styles, such as position trading, as well as those who prefer short-term styles, such as day trading and scalping. Popular indicators for momentum trading include the momentum indicator, the relative strength index, moving average, and the stochastic oscillator. Thank you for watching.
Okay, hi everyone. Welcome to today's webinar. So today we'll be doing Fibonacci series, our first part of 4 on retracements. So we'll give a couple more minutes to let more people join our meeting. And we'll start perhaps at 6:05. So in the meantime, you can grab a drink, get yourselves comfortable, and then we'll start in a couple of minutes. Maybe in the meantime, I'll do like a sound check. Can everyone hear me? And can you see my screen? Yeah, okay, that's great. Chat is disabled. Okay, let me try and sort that out. Thanks for letting me know. Okay. Okay, maybe you can try the chat again. I've just tried to refresh the chat. It says everyone can type in the chat. Okay, let me try and figure that out. But this Q&A works. I can see all of your questions, so that's great. Okay, let me try and figure it out. Okay, can you try now and let me know if it works? Okay, that's great. Okay, that was something with the settings. But yes, I've managed to figure out. Yay. Okay, how's everyone doing today? Yes, Sven, it works now. No problem. Okay. So, where are you guys from? Today is actually my first webinar in a couple of months. So it's good to be back. No, today our is the first session for the Fibonacci series. So it'll just be on retracements. Things like the expansions, extensions, and projections will be in the coming weeks. So today we're just solely focusing on retracements. Wow, Finland and Germany. I bet it's really cold there now. Singapore is hot all year round, so I can't relate. Okay, I'm just checking to see if everyone is here. See if I should wait a little bit longer. Yeah, because people are still joining the call, so just be patient with me. Okay, Sven says it's -3 degrees right now in Germany, and in Singapore it is, I think, 27. So -3 must be so nice. I'm sure the weather is it's like so nice and relaxing. Whereas in Singapore we're constantly sweating. It's uncomfortable. Oh, remember, you guys can just let me know in the chat throughout the webinar if you have any questions. Oh, we have someone from Mozambique and another from Africa. That's so cool. I forgot how international these webinars are, so it's so nice to speak to people from all different parts of the world. Okay, I think we can begin. Okay, yeah, let's begin. So, hi guys, I'm Melanie. Today is my first webinar, so be patient with me as I get back into the swing of things. But today we'll be going through the first part of our Fibonacci series. It'll be on retracements. So if you have any questions on projections or extensions, expansions, we'll be touching a little bit on that throughout the webinar, but we'll go more in depth in the coming weeks. So as usual, our disclaimer, the information in this webinar should not be considered as investment advice or recommendations, and it's solely educational material only. So take any piece of information from this webinar at your own risk. And IronFX is not responsible for any loss arising from any information contained herein. Okay, so this is me. I'm Melanie. Yeah. Okay, let's just begin. Okay, so here's our agenda for today. Firstly, we'll be going through the essentials of Fibonacci retracement, followed by the ideal market structure. So what you can look out for, significant swings, how important it is to follow market trends. And then we'll be going through the different Fibonacci levels. So we'll also be touching a little bit on expansions as well as Fibonacci extensions. We'll also be talking about the difference between those as well and how to look out for them when you're trading. So after that, we'll be going through how to combine the Fibonacci retracement levels so that you can increase your chances of a profitable trade. And then we will introduce something called the Fibonacci confluence area as well. And then, this is a typo. After that, we'll be going more in depth, talking about the negative Fibonacci levels as well as the levels more than 100%. Okay, so let's begin. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things to look out for. So firstly, is the market structure clear? So we like to look for really big zigzags. I'll show you what we mean in the coming slides. Secondly, we want to identify recent trends. So is the price going up or down? It's important to always follow the general trend. So you can see in the image that I have included over here at the bottom, um, our starting point is at the top and our ending point is at the bottom. So we can see that there's a very clear downward trend. Okay. Thirdly, you need to identify recent major swing lows and recent major swing highs. So we'll also show you some examples of this in the coming slides. So it's also important to connect the two extreme points, so from highest to lowest or lowest to highest, depending on the general trend. So we'll show you why this is important in the next few slides as well. So over here, we have an example of insignificant swings. So you can see the charts are rather choppy. There isn't really a very clear price movement. And this is what you want to avoid. So this is an example of something that you should not use Fibonacci retracements for. Okay, and this is something that you should look out for, significant swings. So something that has very obvious peaks and peaks and troughs. Yeah, over here. And a very clear move up or down. You also want to make sure that you look for a very clear market structure. So Fibonacci retracements should not cut through too large areas of the market structure. You definitely can, but it shouldn't deviate too much from the price movement. So in this case, we can see there is a zigzag structure, and the retracement drawn here cuts through the market structure, which makes it less effective. So when drawing your trend line, you want to make sure that it doesn't deviate too much. Because you can see from here, our starting point is here and our ending point is here, which cuts through a very large area of the price movement. Okay, let me just check. I'm just checking the chats to see if we have any questions. Okay, someone asked what time frame should be used. I'll get into that in a second, but mostly we want to use the larger time frames so that there's less noise when you're trading. Okay, so this is an example of something that you want to do. So you want to pick market structures with really clear upward or downward movements. As you can see over here, the starting point is at point 1, ending point at point 2. So you can see a very clear downward general trend. Even though it does cut a little bit over here, but that's fine because it doesn't deviate too much from the price movement. Okay. So answering your question earlier, these tend to work better on higher time frames. So like H1 onwards, H1, H4, and so on and so forth, because there's less noise compared to your M5 or M15. Okay, so this is an example of a clear market structure. So although Fibonacci retracements definitely can be used for both choppy and trending markets. And what I mean by trending markets is markets that have like a really general trend, like earlier in the earlier slides. But over here you can see there's quite a bit of movement. But the Fibonacci retracements can be used for these as well. But it's important to look for clear market structure. That's the main point. Over here, you can see this is an example of an unclear market structure. Okay. So one thing we can do to find clearer market structures for our Fibonacci analysis is to adjust the time frames so that the market structure is clearer. So what might look messy on an M30 chart might look very clear on an H4 chart. So I'll show you the next slide. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point of time. It could just mean that you need to take a step back to get a clearer view. So I'll show you what I mean in this upcoming slide over here. So this is an example of a chart on an M15 view. So you can see there isn't really a very clear trend, no clear market movement as well. But if we zoom out and we look at the 1 hour time frame, it's quite clear, especially in this highlighted area. So we have much clearer movement, and it's less messy compared to the M15 one. Okay, any questions so far? No? Okay, let's move on. Okay, so from the past few slides, this first section, it's important to note that the clearer the swing low or swing high, the clearer the trend between the 2 points, the more accurate your Fibonacci retracement will be. So that should be the main takeaway from the first few slides. Okay, so now that we know how to draw Fibonacci retracement trend lines and we know what to look out for, let's look at the different types of levels ranging from negative all the way to more than 100. So in the negatives, we have minus 61.8 and minus 27.2, which are classified under Fibonacci expansions. And all of these in the middle are your Fibonacci retracements. And then above 100 will be Fibonacci extensions. So like I said earlier, we'll go in more in depth in the coming webinars, but we'll just briefly introduce them and how to go about using them as well. Okay, so over here, it just shows you an example of all of the levels that I've mentioned earlier. So for here, the starting point is at this level. Oop. Ending point is over here. Okay, so here's an example of the Fibonacci expansion and how it plays out. So our starting point is here, ending point is here. So for expansion, you want to look for a flash zigzag, which you can see over here from the arrows. It's like a flash kind of symbol or a lightning bolt. So you want to look out for these when you identify Fibonacci expansions. So you retrace the mid-range from here to here. And you make use of the support in the negatives, which means like the negative 27.2 and the negative 61.8. So we expect price to retrace back up to this 61.8% level because price has tested this level earlier, as you can see over here. So it tested this level and then it reversed off. So we expect it to come back down to this negative 27.2 or even negative 61.8. So I'll show you in the next slide how it actually plays out. So here we see the price really reacted off of our minus 27.2%, and then it came back up to our ending point. So typically price, not always, but typically price will come back to the ending point after bouncing off a negative Fibonacci retracement. Sorry, a Fibonacci expansion level. Okay, so let's move on to Fibonacci extensions. So those beyond 100%. So when using the 127 and 161.8 levels for extensions, we want to look out for the V shape or Nike tick as shown here. So in this GIF, you can see how price bounces off of these levels. Let me just start it all over again. Okay, here. So this is our starting point. The shorter end of the tick is your starting point and ending point. And then price will continue to rise from these levels. And after it's reached this level, it reverses off it. We can see over here that it tested the level once again, but it ultimately bounced off it to reverse and drop back down. Okay, let's move on to the next slide. Okay, so when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, if there are bars on the right that break your ending point, it becomes invalid. So there are Fibonacci retracements that are negative, so like the negative 27 and negative 61.8. And we'll touch on these as they go basically beyond the endpoint, and yet they are still valid. So I'll show you what I mean over here. So this is an example of an invalid retracement. So the ending point, which is here, you can see that price actually reversed off the ending point, but it made a lower low. So this Fibonacci retracement over here, the trend line, is now invalid. Sorry. So similarly, if it's going higher, if it breaks the ending point and it goes even higher, then it's invalid as well. Any questions so far? No questions? Okay, let's move on. Okay, repeat the last bit. Okay, so how you identify once your Fibonacci retracement is invalid is when, so you can see over here, price is moving downwards. In this case, it's a downtrend. So when it's moving down, do you use this lower low as a new ending point? Yes, correct. Yeah. So you can see it's moving downwards. This is originally our ending point. But since price reversed off this level and went even lower, so this should be our new ending point. So even though I said earlier that you shouldn't cut through the price movement too much, in this case, it's not a large area, so you can still cut through this area because the general trend is still downwards. So this should be your new ending point. I hope that's clear. Okay. Any other questions? See the previous slide. Sure. No worries. So the main key point is that once it breaks your ending point, it becomes invalid. Okay. Okay, let's move on. So now let's take a look at Fibonacci extensions. So here you can see a very obvious Nike tick. The starting point is here, ending point is here. For Nike tick, you want to take the shorter end of the tick, the starting point. So you retrace this area, this trend line is over here. And it results in a reversal over here. When you use this trend line, it gave us a 161.8 projected level. So we are expecting it to rise to this level and reverse off of it. Oop. So 127 would be perhaps in between here. So you might want to wait for price to break through the 127 level before going in for this trade at 161.8. Okay. Okay, let's move on. So we've gone through earlier the key Fibonacci levels that work, the expansions, extensions, as well as the retracements. So there's always a huge debate on whether some levels work better than others, but the truth is that Fibonacci retracement levels work sometimes, but they work all the time. So that's the problem. So how do we minimize this issue and increase our chances of being profitable? So what we've come up with that works by combining Fibonacci retracements. How do you expect that it will go to 161 and not 127? Okay, so so as I mentioned earlier, 127 would be perhaps around this area. So you might want to wait for price to break through the 127 level before going in for the trade for 161. Because at the 127 level, it could reverse or break through. So you want to wait for it to break through before going in for the trade at 161. Does that make sense? Okay. Okay, no worries because let me just like try and explain it again. Because the 127 level is obviously below the 161 and above the 100. It's in between. Should be in between this area here. So if price hasn't reached the 127 level yet, um it's not advisable to go in for the trade at 161 because it hasn't broken the level yet. So it could reverse off of the level or it could go up. So in this case, we know that it went up. So after it breaks through the 127 level, then we can go in for the trade at 161 projected level. Okay, I hope that helps to like clear things up. Okay, so let's talk a bit about combining the Fibonacci retracements. So the trick is to find multiple Fibonacci retracement levels that line up together so that you can increase the probability of a bunch of Fibonacci retracement levels working instead of a single Fibonacci level working. So this is the definition of Fibonacci confluence. So we'll show you an example of what we mean and how this can play out in the next few slides. So, okay, maybe I'll start with this photo first. So over here, we have a negative 27% Fibonacci retracement. So you can see this is the starting point and the ending point is here. Okay. So then we have a 161.8 Fibonacci retracement. So that would be starting point here, ending point here. And then we have a 78.6% Fibonacci X. This should be Fibonacci retracement, sorry. The 78.6. So that all lines up nicely and we expect price to bounce off of this confluence area since all three of our Fibonacci levels line up together. And you can see that price really bounced off this area and it resulted in an uptrend after that. Okay, I have a couple more examples, so if you're a little bit confused, don't worry about it. But if you have any questions, you can pop it in the chat as well. All good. Okay. So here's our first example. So we have a Fibonacci retracement starting from here and ending here. And this gives us a 50% Fibonacci retracement. And the level is in yellow, this level over here. So that's the first one. Secondly, we have a Fibonacci retracement starting from here and ending here. And this gives us this green area over here. And then it lines up nicely with the 50% Fibonacci retracement. Okay. So lastly, we have a 127.2% Fibonacci expansion starting here and ending here. So ultimately, we have three Fibonacci retracement levels all lining up, and it gives us a very strong Fibonacci confluence area. So what we expect is that what we're going for is to play a bounce from a strong area of Fibonacci confluence support, which is basically all the colors lining up this area. Okay, so we'll show you the result of this. So as you can see in this picture, price went down to touch this strong area of Fibonacci confluence support, and it bounced up nicely. Okay, any questions so far? Yeah, so you're combining one big Fibonacci retracement level with two other smaller Fibonacci retracement levels. So you can see this is the really big one, and then you combine it with the two smaller ones over here, the green and the red. So you just pull out your Fibonacci retracement levels, and then you can just connect from the starting point to the ending point of each. And then you see where the levels line up, and that should give you a strong area of confluence. Okay, hope that clears things up. Okay, let's move on. So here we have another example. So in this example, we combine one Fibonacci retracement with two Fibonacci extensions. Okay, so the very first one, let's start with the yellow one. Starting point here, this is our middle point, and our ending point is here. So this is the Nike tick that we mentioned earlier, the Fibonacci extension. Okay, and it gives you an 88% Fibonacci extension, which lines up with the 61.8% Fibonacci retracement. Starting point here and ending point here. You can see a very clear downtrend here, the green arrow. Okay. So for the last Fibonacci extension, we have another flash over here, the red arrows. So remember, for Fibonacci extensions, we're looking for the flash symbol or lightning bolt symbol, however you want to call it. So for yellow, it's like this. For red, like this. So for red, it gives us a 61.8% Fibonacci extension. So we can see that all these three levels line up and it gives us a strong area of Fibonacci confluence to trade from. So what I would do is wait for price to make a push up to this area, because currently price is at this red line here. So I wait for price to make a push up to this area, and when it touches this area, then I would short the market and play the drop. Okay, so this is what I mean. By waiting for it to go up to this area and wait for the reversal before you short. Any questions about this second example? Okay, so let me just go back to the previous slide. Yeah, so here you can see there's three different Fibonacci, two different Fibonacci extensions, as well as one Fibonacci retracement. So the Fibonacci retracement is the one in green. Fibonacci extension is the yellow and the red. And how you know this is because of the flash symbol. So like it's like a lightning bolt. Yeah. Okay. I'm just reading some of the chats or the questions. Okay. Okay. I'll move on. So for the third example, we're bringing in support and resistance levels. And this leads to really high probability setups. So here is an example of how we combine pullback resistance and two Fibonacci retracements as well as a Fibonacci extension. Okay, so I'll show you where each of them are. The red level over here is the pullback resistance. Because price tested this area, it bounced off of it and it crossed this area over here. So this is a pullback resistance. The Fibonacci retracement is the yellow line, starting point here and ending point here. This gives us 61.8% Fibonacci retracement, which lines up with Fibonacci extension, which is over here. We can see the flash sign again in the green arrows. Can you guys hear me? Someone said they can't hear me. I think the audio is fine. Okay, let me just reply. Sorry. Okay. Where was I? Okay, yes. So you can see the flash over here, the flash signal. This is a Fibonacci extension, the green arrows. And then we have another Fibonacci retracement, which is the red arrow. Okay. And all of these three levels line up with our pullback resistance. So it's a very strong Fibonacci confluence. And it's also a high probability reversal zone that has the potential to see price reverse strongly from this area. So in such situations, you could place a short entry over here at this area. Okay, let's see how this played out. So you can see price reversed off of this area. And it reversed right as it hit the confluence area. So because this area is so strong, and you can tell based off of the Fibonacci retracements lining up, as well as the pullback resistance, or any support and resistance levels that line up with the Fibonacci retracements should give you a very high probability reversal zone. Okay. Are there any questions about any of the three examples that we've gone through so far? Yeah, I'll give you guys some time to digest what I've just gone through from the three examples. Sorry, catching a cold. Because it's been so rainy in Singapore. Okay, so the main point from all of the three examples is basically to stack a bunch of Fibonacci retracement levels or support and resistance levels to try and get the most high probability confluence area that you can get, and then see whether it has a high potential for price to reverse off of it. Okay, let's move on. So here's some trade management tips with the Fibonacci confluence. So for stop loss, it should always be beyond the key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out right before the market reverses. And this is one of the reasons most people wonder why they get stopped out right when the market starts to reverse, and then they complain about it. So, but not you, because now you know. So you can see over here, your stop loss is below it or beyond this Fibonacci confluence area. So there's some buffer over here. So just in case the market doesn't go exactly how you expect it to when you buy, so your stop loss is there's some leeway. Okay, so let's move on to the take profit. So your take profit should always be before your Fibonacci confluence. I see the slides are slightly incorrect, but for take profit, it should always be before a key Fibonacci confluence area. And the reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. So you can just ignore the slide here, but take a look at the image below. So our take profit is before the big confluence area. Why? Because there's a high chance that it will not be able to go beyond this area. So instead of reaching your profit target, it might reverse back to your entry, or even worse, your stop loss. So this is one of the reasons why people may complain that the market is being manipulated, because they miss their TP, their take profit, by 1 pip. So you should always put it before the major Fibonacci confluence. As you can see, there's also some leeway over here. So um, there should always be a little bit of buffer between the Fibonacci confluence as well as the take profit and stop loss. More of like a just in case measure. Are there any questions? Okay, I think there are no other questions. So that brings us to the end of our webinar. Okay, so before you guys go, let me just pull it up. So IronFX actually has a VIP trading room. Not sure if you guys know, but I'm just gonna let you guys know right now. So depending on your deposit, you can access the different premiums. This is on the IronFX.com website. So you can just take a look over here and you get VIP room access. And what I mean by that is over here, this brings you to our page. So let's say, for example, today we went through Fibonacci retracements. So you've been through our webinar, but it won't really help unless you have the space to practice. So the VIP room gives you the space to practice however you want. Let me just remove everything. So we have Fibonacci retracements, extensions, any horizontal rays that you guys want. So for example, if I see that this is a resistance and I'm not sure if my analysis is correct, you can go ahead and type a message in the chat box. So like maybe Desmond, hey, you can see that there are a lot of people in this chat. So if you put it in, there are many people who will be willing to help you, as well as some of our pro analysts as well. I am also in this chat, so you can go ahead and type it in. I don't know why it's not showing up. Okay, but you can tag whoever you want. Hey Desmond, is this resistance valid? And then you can highlight the resistance, link object to text, and then click on this. And then you can just send it in. So we try to reply as soon as possible. I think within 24 hours, you should get an answer. Yeah, so if it works for Fibonacci as well, if you want to check your retracement, like, is this valid? You can go ahead and tag that as well. Link object to text, and then you can choose which level you want. So maybe like 50%, and then it will choose it for you. So confirm, and then when I go over it, it will highlight it. So whoever is reading your chat will know what exactly you are referring to, and they'll be able to help you better. Same for the Fibonacci as well. 50%, so you can see the 50% is being highlighted. Okay. Okay. If there are any other questions, you guys can drop them in the chat. But if not, yep. Thank you guys so much for coming today. Let me just open the chat. Okay. Yeah, thank you guys so much for coming today. Have a great rest of your week. And I'll see you guys next week. Yeah, I think there is a way to see the recording. I don't think you can download the presentation slides, but the recording for this webinar, yeah, it's being recorded. Let me just see where you can find it. I think you can check the IronFX page, the website. Okay. Any other questions? No. Okay, thank you guys so much. I'll see you guys next week. Yeah, this may be a little bit difficult to understand, but no worries, you can go back and watch my presentation again. Um, and practice it on your own in the VIP trading rooms, and we'll definitely help you out over there. I think it would help you understand better if you actually played around with the Fibonacci retracement levels. Yeah, thank you guys. Bye.
Hello everyone, my name is Emily and welcome to another of our great educational trading videos. Today we're going to look at day trading. Day trading is a very popular short-term trading strategy that involves the buying and selling of financial instruments during the trading day in order to make a profit from small price movements. The most important rule of day trading is that traders need to close out all their positions at the end of the trading day. Generally, the day trader aims to take small profits that can add up during the day or trading period, while at the same time minimizing their losses. While day trading is a viable trading strategy for many experienced forex traders, beginner traders could find day trading to be challenging. Without a well-defined trading plan and the discipline to adhere to its rules, beginners might be overwhelmed by the stress of intraday trading. Day trading strategies can differ from longer-term trading strategies as they focus more on profiting from shorter-term movements in the market compared to moves that take place over a number of days or weeks. In this respect, day traders need to be continuously focused as markets can move suddenly in the short term. Overall, advantages of day trading include instant results and no overnight risk. On the other hand, the disadvantages include requiring a high initial deposit to make substantial profits, less time to think, and there is also a risk of overtrading. Thank you so much for watching us today, guys. Bye-bye.